In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, welcome back, Market Rebels and all of our traders out there. And Stu, a little bit of, I'm just looking at the close here, a little bit of a bearish engulfing pattern there on SPY. We're down about what 1.3 or something, I think I saw.
Yeah, the bullish world of option trading and stock market didn't win today.
Certainly didn't. But we had, good numbers on NVIDIA, but we were just looking at the straddle on that too, and it really sold off quickly on the opening bell.
Oh yeah, couldn't hold it. It was a little higher in the after hours, but it definitely couldn't hold it. And the straddle, of course, got killed. I mean, they were looking for a applied move of $50, and here we are, basically up 58 cents.
Unbelievable. Yeah,
unbelievable.
Straddle traders got their heads handed to them. But today, what I thought might be good to kind of ride on the coattails of NVIDIA there's a sister strategy called a strangle. You can also
how does it go from 50 to 11 overnight? I don't get that. Okay, anyway, move on.
I know. People need to realize that. But there's a related strategy going from, we can go from a straddle to a strangle or leg into one. And so I thought there might be a nice little tip we could share with people. I know we've talked about it in Q&A recently for all of the people in our lunch bunch. Yeah. So let's go ahead and take a look at our Chalk Talk for today, which for anybody who's new, first of all, welcome. We like to open up with a little thought-provoking question, and then we'll answer it at the end. So here's the question for today. You bought a $100 call trading for 3, and then at a later time, you bought the 105 put trading for 1. So the question is, what's your maximum loss?
Well, let's see. I spent 4. Whoops.
Now, I know you know, but that's what most people are going to look at, because most people are trained that the amount you spend is what you can lose. But there's other things you have to understand about options so that you don't get caught in these traps. In this case, it could be a good thing, but if you're on the opposite side, then it's a bad thing.
Yeah, I was kind of putting something out there for the people to just think about, what not to think about, but not to look at. Actually, that's a hint,
right? And it's also just to show how tricky things can get. Even though we're always dealing with just calls and puts, long and short, things start to get tricky because they hedge. And that's what we're going to find out here. So we're going to take a look at a special type of a strategy that is sometimes called an in-the-money strangle. That's an easier way to say it. We'll talk about the more technical name for it later. But that's what we're going to ask. what's an in-the-money strangle and why would you use one?
Sometimes known as what was the other one? Some people might know it as a gut strangle.
Yeah, we're going to talk about exactly right. So let's take a look at, first of all, another thought-provoking question. This is one we threw out to our Q&A people, but it's going to really set the stage for what makes this strategy work. Because a lot of times traders that are new to this guy don't understand what's making it work. So here's your question. We have two guards that are facing in the opposite directions, yet they can see each other. How do they do it? Now, people usually say there's some type of mirrors, reflection, nothing like that. This is all the information we have. They're facing in opposite directions, but yet they can see each other. All right, so we're going to give people, we need that little Jeopardy music, Stu. I'll give them about 10 seconds
John's
here to think about it.
Here. Come on, John.
Yeah, exactly. We need our Jeopardy music. So anyway, ready for the answer. Drum roll. What do you think, people? Here's the answer.
How easy was that?
They're facing each other.
Unbelievable.
Now, see, most people don't think that when they're in opposite directions that they could be facing each other, but they are still in opposite directions. Mm-hmm. One guy might be facing north, one guy might be south, but they just happen to be facing each other. And what we're going to find is that if you think about it, this area in the middle now gets kind of double guarded. See, when they're facing away from each other, if you wanted to kind of sneak into the castle here, there's a blind spot between them. But if they're facing each other, it doesn't matter if you come out here to the left or to the right or between them, you're going to be in view. And that's really the trick to understanding what makes an in-the-money strangle work. So that's what we're going to look at today. And as always, for anybody who's new, please join us at marketrebellion.com/get started. Lots of great information on the site, articles, videos, all kinds of things. You got to be very careful. In as much as we are beneficiaries of the internet, there's a lot of really bad information out there. We want to make sure that everybody
got to be really careful about it.
Unbelievable.
Who you're watching and what are you going to do with the information that you're getting?
Absolutely. So again, if you're just getting started, this is a great place to help you get started, absolutely free. So let's start off with a strangle, Stu. There's a kind of a sister strategy to a straddle. It's called a strangle. And what you're going to do is to buy a call and a put with different strikes, but the same expiration. Now, normally, what we might call a standard strangle, we're going to make the put strike lower than the call strike. And that's what we're going to see sets up the in-the-money strangle.
And somewhat equidistant. You know, it can be different, but generally it's going to be
right. We're usually going to put the stock price right between them. That's one of the reasons that we would use a strangle instead of a straddle. So let's say if we bought the 100 put and we bought the 105 call, the stock might be somewhere around 102, 102.50, kind of hovering in between here. And if we don't have a strike that is right there at 102.50, sometimes we do, in that case, we might choose a straddle. But if we don't want to lean to the hundreds because then we'll have a bullish bias. If we lean to the 105s, we'll have a bearish bias. We want it to be neutral. And so this is a way that we can do it by splitting those strikes. So in this case, we would say that we are long the 100, 105 strangle. Long just meaning that we bought it. Now, if we do it, what's our risk graph going to look like? Our risk graph, if you kind of picture this in your head, we've got our deltas going off to the downside for the puts. We've got them going to the upside for the calls. And so we're going to look like this. Now, if we did a straddle, it would actually be a V. We wouldn't have this flattened off portion, lopped off portion down here. But other than that, it's the same idea.
Yeah, just think about it. You're long a call and you're long a put.
That's right. You're playing both sides of the market.
We're kind of talking about that today in Q&A. Look, when you have these strategies, some people call them complex strategies. I don't know why, but they're not real complex. It's just more than one. It could be a couple of legs, 2 legs, 3 legs, sometimes 4 legs. Break it apart. It's an easy way to look at it. Just break it apart. What do you have? This is a strangle. This is a call and a put. One's a call, one's a put, and you're going to have each line representing each option. And you just put them together, and this is what it looks like.
Yep. So again, they're sister strategies, meaning that the reason you would do one of these, straddle or strangle, is that you're expecting either a really big move up or a really big move down. Now, off the bat, that sounds like, hey, why wouldn't you always do straddles or strangles? Because now you're playing both sides of the market. Sort of. because you've got only one of these at expiration is going to make money, but yet you're paying for the call and the put.
Yeah.
So in a way, you're kind of doubling up on the price.
They're not going to both be in the money, at least at expiration, or at any given time prior to that. They're both not going to be in. There are one or two exceptions to that, but for the most part, they're one's going to be in the money, one's going to be out of the money.
Right. But so if you think about it, you need to make up the cost of both of those. And so that's kind of the kicker to these strategies. You don't just need the stock to go up or down. You need it to make a really, really big move up or down.
Or big enough to cover the cost.
Right. And you need to do it before expiration. So you've got very wide break evens in here. So this is the kind of the general shape of it. And again, this is called a strangle. Mm-hmm. All right. So let's go to step 2. And as always, another little plug here for anybody who's new, please check out marketrebellion.com/get started. And now let's answer an interesting question. What if the strikes are reversed? All right. So we just looked at where we had the 100, the lower strike was the call, and the higher strike, the 105, was the put.
Mm-hmm. Usually it's the other way around when you talk about strangles.
I'm sorry. Right. This is the original. We had the 100 was the put and the 105 was the call. What if we do this?
Right. This would be the in the monies.
What if we flip them? Mm-hmm. So now we have the lower strike as the call and the higher strike as the put. Now, normally
how do you make them do that circle on Excel?
That's not in Excel. It's in PowerPoint.
Oh, there you go.
It's just one of the little animations in there.
Okay.
So anyway, the thing is, this is what sets up the in the money. And we might call this being long, the 100, 105 in the money strangle. Now, why is it called in the money? Well, because if you look, no matter where the stock price is, it's like these guards are facing each other. We'll look at that in just a moment. There's no place where this strategy can lose. Now, before you rush out and start buying these things, that also means you got to pay for it, right? In the financial markets, you have to pay for all advantages. So if there's a $5 guaranteed value coming back, it's going to cost you another $5. We'll see why in just a moment. But as Stu said, this is actually a family of what are called gut strategies. This is a gut iron meaning that we're using calls and puts. But the gut part really kind of means that we're locking in this space in between. So if you think about it, we cannot lose. And we'll see some examples in a moment. But no matter where the stock is, if it's below 100, the put's in the money. If it's above 105, the put's out, but the call's in. And if it's in between, they're both in the money. See, we have no area where this can lose. So now what happens to our risk graph? This was the original one where we had the put.
Let's reiterate for 1 second here.
Mm-hmm.
When Bill says you cannot lose, what he means is it has to be priced correctly in the marketplace.
Right.
Price is going to be, as you say all the time, right, the great equalizer in life. I mean, if the price is incorrect, yes, you can lose, but the cash equivalence would make it impossible to lose. It's the added money that you'd be paying that could push you underwater.
Right. And you're right. I should have clarified that. When I say you can't lose, it does not mean it's a guaranteed profit at all. Right. What it means is that this spread can never be worth zero. It just can never be worth zero. So here was the original one where we had the put on the left and we had the call on the right. And I just made up a number and said that they're $8 total. So the bottom of this graph, the most you could lose is right there at 8. But if we flip them, if we put the call on the left and the put on the right, we've now boxed in an extra $5. So what do we know? It's got to cost $5 more. It's going to sit another $5 lower on your graph. Other than that, it looks just the same. But again, this is where some traders will look and they'll say, oh, I don't want this one. Look how expensive it is. But they don't realize that $5 is absolutely positively coming back.
Right. You got to look at what the cash portion of each option is.
Right. This has just got $5 of cash built in it. We'll see why that's important in a minute.
And this is yet another reason why you have to know the difference between intrinsic and extrinsic and what makes the price of an option.
Absolutely. So let's take a look at a pricing model. If we look at the call and the put, okay, If we had the put on the left and the call on the right, the call can, let's call it, guard all spaces to the right or capture profits to the right. The put can capture all profits to the left.
Because why? Because they are the right to buy or the right to sell. The right to buy stock at 105 on up. At 105 and you're covered all the way up, and the right to sell stock on the left, the right to sell stock at 100 and you're covered all the way down. What about in the middle?
So this is like the two guards facing away from each other.
Mm-hmm.
That's why we use that as an analogy. So the 105 call, think of the guard looking out here to the right. Yes, this is going to capture all the intrinsic value if the stock rises above 105. The put is the guard looking left. That's going to capture or kind of protect all the prices below 100. But notice that we have a spot in here that's the kind of the dead zone that I talked about, right? If we could go right up between 100 and 105, in other words, if the stock closes somewhere between 100 and 105, this thing is worth 0. You will lose 100% in it. Now, watch what happens when we flip them. We're going to put the call on the left and the 105 put on the right. What happens now? Now the guards are facing each other, right? Now we get this. And notice that this section in the center is double guarded. See, we have no area where you can lose.
They're still the same rights. They're just a right to do something at the other, at the opposite level, right?
We've made these options face each other. Okay, so does everybody see that the put, again, guards everything to the left by this red arrow? The call kind of guards or captures everything to the right. But because the call is below the put, they both double guard this center. See, that's not true up on the top when we put the put on the left and the call on the right. We can lose everything in here. This is a way that professional traders will use under certain circumstances to box in a guaranteed gain, but still hold out for more. That's kind of what prompted this idea here with NVIDIA today. When you see stocks that make these massive moves and you say, you know what, it could continue higher, but it could also come whipsawing lower. Maybe we could box in a guaranteed gain and play both sides. They come up. You just need to remember, you don't need to use every single strategy, but you need to know the right tool at the right time. So let's go into the pricing model and take a look at these. Stocks at 102.50. We're going to give it 30 days to expiration, 30% volatility, no interest. And the question is, what are the values of these two strangles that we just looked at? Well, based on what we looked at in the diagram, they should be $5 more. Now, the reason I brought this up, and I would certainly encourage everyone out there to do it, go to like the OIC's website, pull up an option pricing calculator, and try it.
Council.
Yeah. And check for yourselves. Just make up some numbers. Stock doesn't even have to be in the in between them. It could be anywhere. Make up some numbers. Look at the two different strangles with the put on the left and the call on the right, and then just switch them and go and look at your prices. And what you're going to see is this. Using those inputs from the previous slide, the $100 put is worth $236 and the 105 call is worth $244. Strangle is worth $480. All right. Now, if we switch them, we've got the 100 call, right? We've got the lower strike call on the left. We had the 100 put. Now we're going to make it the 100 call is worth $485. Why? Because it's got some intrinsic value. Remember, the stock's at 102.50.
All right. I was just going to say that these are in the money, these calls.
Mm-hmm. And the 105 put is also in the money, hence the name, in the money strangle. So we can see that it looks like it's really expensive. But to a professional trader, your eyes should say, well, hold on a second. We have a $5 box in here. So I really should be able to subtract $5 off of this. So take a look. The price of that is going to be $9.80, and take a look at those. It's exactly $5 more. And again, that's because you're going to get $5 back at expiration. So it's a little bit of a misperception. Everybody thinks, oh, why would you want to do this? It's so expensive and you could lose $9.80 instead of $4.80. They're exactly the same thing. But if you want to break them apart and maybe do some morphs, wouldn't you rather have a higher strike put and a lower strike call, have more intrinsic value if you need to break them apart? There's a lot of benefits.
Yeah. So look, if you could pay $9.80 for this, which you won't, but if you could pay $9.80, you could actually lock in 20 cents. right? If you could pay 9, you could lock in $1.
Yep.
You could do that, but it's not going to happen really in the marketplace. There's too much arbitrage in there for that to happen. But so now we have extra dollars, and where the extra dollar is going to be, they're going to be in the extrinsic value.
Yep. But also remember, we can leg into these over time. So yeah, you're right. You're not going to be able to get these as an arbitrage at the same time. That's why in the original question I said at a later time.
Way to hedge an existing position.
Correct. Exactly. That's more of where I would use them. Yeah. So let's take a look at what happens in the pricing model here. We're going to look at various stock prices over here, 90 to 115. Let's start with the out of the money, right? We've got the put on the left, the call on the right. At expiration, the 100 put is worth 10 with a stock at 90. Stock at 95, it's worth 5. And then it's a 0 elsewhere. The 105 call is 0 for all prices 105 or below, and it's worth 5. The stock is 110, and it's worth 10 at 115. But notice there is an area in the middle where they can both lose. And this is the situation where the guards are facing away from each other. We got a blind spot in here.
The typical strangle, the out of the monies, both out of the monies here.
Yep. But now watch what happens when we make the guards face each other. Okay. Now we're going to get these prices. We're going to get 0 and 15. If the stock is 95, we get 0 and 10. Now we get 0 and 5. See, the call's at the money, but the put's $5 in the money.
Yes, it is.
The stock is 105. What happens? Now the call is $5 in the money. The put is out at the money, but it's going to be just as good as out of the money at expiration. But we cannot get zeros. Look what happens at 110. Calls worth 10, puts worth 0. 115. Calls worth 15, puts worth 0. But there is no place, if we were to add these up, where we get zeros. See, there is over here on the left. And if we compare left to right, this is worth 10 in total. This is worth 15, $5 more. Over here on the left is worth 5. Over here is worth 10. Over here is worth 0. Here is 5. The right two right here, the in the money strangle, is always worth $5 more. Why is that? Because we have $5 difference in those strikes and we've boxed them in.
Right. That's what I was talking about before. So, it's a hedging technique. And you can use that as the stock moves around because the values of the options are going to be moving around. You can absolutely use this kind of a technique to hedge in and actually fully box it off with the sales of the other two. But we'll save that for another time. But go ahead.
Yeah. So anyway, here's our chalk talk question. Hopefully everybody sees the answer now. But you bought the $100 call for 3. Now notice what I said at the beginning. I said at a later time, you bought the 105 put. You would not be able to do this at the same time. This would be an arbitrage. It would require that you had to wait. So let's say that back with NVIDIA, now of course the options weren't going to be this cheap, but the idea is that maybe you had the 100 call, and as it's taken off like a rocket ship, what could you do? The puts are getting cheaper. And at some time, depending on what you paid for the call, you might be able to buy the put on the cheap, relatively speaking, and box in that difference, locking in a guaranteed gain, and still play both sides of the market.
Yeah. See, maybe you bought the call for 3, and now the stock's way up. Now the call's trading at 10.
Right.
And maybe the put at that point might be trading for 1. Yeah. Maybe. And you could pay 3 and 1 and 4 then you could lock it in, and you still have your giant wings on either side of the equation, which would have really worked. Which would have worked pretty well on NVIDIA.
Yes, it would
on the opening today when it was trading up around 500.
So here's the question for everybody that we asked: what is your maximum loss? All right. So here's what the main thing we want you to get: what you have to do when you start dealing with strangles or legging into positions over time. Maybe we bought the $100 call today. A week later, we buy the 105 put, or tomorrow, or later that day, but they weren't done at the same time. We spent 3, we spent $1, we have spent 4. And most traders have learned that the most you can lose is what you paid, and they would say your maximum loss is 4. But what they're missing is the $5 box. So did y'all catch that? Notice that both of the guards are facing each other. The lower strike call is below the higher strike put. They are facing each other, and we've now boxed in 5. We have a guaranteed $5 coming back. So what's our risk graph look like?
Guaranteed $5 value, which you're paying $4 for.
Yep. So we've got our risk graph now looks like this. We cannot lose, but we can still, if the stock continues to run, we can make money. And if it happens to turn, it would have to be a very big, violent turn. But we kind of saw that today, didn't we? But it's really a nice strategy when you're trying to play high volatility stocks like this. It's a nice way to lock in a guaranteed gain, but still kind of play both sides. And that's done with the in the money strangle. It's one of the many uses that we use them for. So again, we hope that helped you to pick up one more tool for the toolbox. Stu, any final comments?
Yeah. So this, something like this, one of the questions that I get a lot in coaching is, how do I know when to get out? How do I know when to sell? How do I, the theory behind this gives you an out. It doesn't give you, I'm getting out of the position, but it gives you an alternative way to hedge a current position that is working for you while staying in and seeing if you can make additional money on the tail end of whatever move it is that you're looking at here.
Beautifully said. And it could be done. You could start with the put too and leg into the call.
Sure.
Or you could break them apart. So it becomes a very flexible type of tool. But anyway, again, that's the kind of the loosely speaking, we usually call them an in the money strangle. It's technically called a guts strangle, not the best sounding name for out of all of the weird strategies that we get out there. But if you just think of it as an in the money strangle because the guards or both of those options are facing each other, and therefore you have no areas where you have any dead zones where they can both expire worthless. So we hope that gives you some things to think about. As always, it's about taking it one step at a time. And over time, you'll become much, much better options traders because there are amazing opportunities in the markets always. So with that, we want to thank all of you for being here, and we'll look forward to seeing you next Thursday, 4 p.m. Eastern on Coach's Corner.
Absolutely. Take care.
See you then. See ya.
Hmm.